Hey traders, good morning. Happy Friday to everybody. This is Ron Haid at Market Tamer. As always, nothing in this presentation shall constitute a recommendation to buy or sell any security. Trading stocks and options involves risk and specific financial issues should always be addressed with your financial advisor. We have some stocks on the move today due to earnings last night and some follow through from earlier in the week. I'm going to kick off with the Qs. As I record this, it's about 9:35 a.m. Eastern, so the market's open for like 5 minutes. ES futures are down a whopping 1 point. The Qs themselves, they're up about 0.5% right now, in part due to Amazon, which we'll get to next. They're still looking bullish, as are the overall market. So let's get right to it. Here is Amazon. Stock is up 63 bucks. It was as high as up $80 at one point, new all-time highs. A lot of this is coming from the AWS, aka the cloud, as a big driver for Amazon. They're off their highs right now, but this is still bullish. If we get to the end of the day Friday, and a lot of these stocks that are gapping up, and the Qs overall finish the lows of the day, could show a sign of some exhaustion. But right now, for Friday morning, it's looking good. Here is Twitter, TWTR. Twitter's down 13%. Big drop, almost $6. The support level pretty much is going to be in this consolidation area, which is right near the 200-day moving average. It's one more reason why protective puts can save your bacon. Now, I'll also look at protective puts for Amazon with a gap up, and we'll talk about how those puts would have lost value, but the stock still went up. So we're going to do comparative collar trades on Amazon. We can even do it on Twitter again. I'll do that on the weekend. I'm not going to do it today because I want to take a look at Facebook before we get done. So right now, your target there, technically. Starbucks had earnings, but they're not moving much. They're only down about 1% right now. It's not looking good. I mean, the stock's already down from, upper 50s to upper 40s. So you could say the down move on bad guidance, bad earnings is already in. But as of right now, you would go right back to the lows, right around 48 or so for support. Exxon Mobil's down about 3%. It's off the lows. The target, and there's so many other lines here. Let me just delete them. But the 200-day moving average is in purple. But here's the thing on Exxon. This was such a nice slow rise where it was ebbs and flows, basically holding on to the 50-day for the most part. Now you're into here. It's just a choppy mess. If we get below the 200-day, you would just keep going to swing lows. Intel, ticker symbol INTC, is down over 6% at 7% at one point or close to it. We're right at the 200-day. Now, if I zoom in here, the 200-day is here, which ties in with these lows. The next support level is down here at 42.50. That would be over a 10% drop again. In fact, it could be as much as 15 to 20% potential. You can see that once the stock got below the 50-day moving average in orange, 2 of the last 3 days, we hit our heads on that. The buyers were not willing to step in ahead of earnings, and now we're sitting down here. It was just a cautionary tale. And I'm still watching Berkshire, BRK.B. It's doing okay right now. It's just been bouncing sort of in a bull flag after the breakout. If I wanted to be a little more cautious, all I would need is a close back above the breakout high. This move, that strong move on top of that big volume is good. This is just consolidation. There's a pennant in there. It's a flag. And I would consider a 20-day EMA as a potential selling stop there. So I'll keep an eye on this one. And now we'll finish up with the Facebook collar trade, or at least the Facebook protective put strategy or married put strategy. As of right now it's about 9, almost 40 Eastern, you can see there's a black candle. We gapped up, we're finishing lower. Facebook is still bearish on the charts, but how does it look? How would a collar trade play out using yesterday's options? So if I go to the Analyze tab inside Thinkorswim, and I back the date up to July 25th, the stock was trading at 217.50. Let's just assume we wanted approximately an at-the-money put. Now, we could go 217.50, we could go 215. You say tomato, I say tomato, doesn't really matter. Let's just take this one and let's say it's 665 is the cost. There's a ton of open contract there too. We fast forward 1 day. The stock drops $41 at the end of the day. So there's also a lot of implied volatility, suck out or evaporation, if you will. Now the 215 is worth $39.10. Let's just say 39 bucks. So if we round up our put cost to 7, not 665, and we take that to 39, we have simple numbers to use. Basically, the put's up about, actually we'd use 38 because we'd be selling it. So let's do 7 bucks to 38. That's $31. So the put is up $31. The stock is down 41. You might say, well, geez, we're still down 10 bucks. That is the name of the game when you're using a collar trade. It's about capital preservation. In this particular instance, we're only doing the married put where it's long stock, long put. So for every 100 shares of stock, I'd have one long put option in this example. So being down 10 bucks, not so bad. If I had used a covered call and I backed this off, even if I would have stayed in August, and let's say the stock was at 217, I went up to maybe 230. Here's almost $3. If I go to 227, now I might only be down $7 a share. And if you said to somebody, hey, you could be down $7 to $10 a share, or you could be down $41 a share, what would you pick? And I think pretty quickly you'd say, holy moly, I'd rather have, a much smaller loss. That is the whole purpose of a collar trade, to minimize risk. Now, if covered calls weren't used, that's fine. You're still down 10 a share in the example I used. If we had gone, let me go back a second. If we had picked the 217.50, we would have paid, let's say, 780, and now that would be worth 43. So it's a little better, but you're still in the same ballpark of down about $8-9 a share. Or I'm sorry, this one here, you're down about $8-9 a share. So you pay more for the put, you go deeper in the money, higher up on the strike price. Yes, if it drops, that option could potentially make a little more money for you. But then if it doesn't, the stock goes up, you lose a little more money. That's why we typically just do at the money options, whatever is closest. So I hope you find that helpful. Again, put some of these in a paper trading account so you can practice with them, because there's going to be another earnings palooza next week as well. If you have any questions, let me know. I'm happy to do another example. Email address is cs for customer service @marketstamer.com, and I look forward to seeing you again in Sunday's videos. So have a fantastic weekend, everyone.